Okay, let's be real for a second. We've all got one. That one stock in your portfolio you just hate looking at, but for some reason, you just can't bring yourself to sell it. Well, today, we're going to break down exactly why that happens, and way more importantly, how to finally break free.
So let's just start with this question, because it's a wild one when you think about it. Why do we treat our losing investments better than our winning ones? I mean, it sounds completely backward, doesn't it? To be more loyal to the thing that's costing us money.
Well, that's because it is backward. Get this, the average investor holds on to a losing stock 4 times longer than a winning one. Not twice as long, 4 times. This isn't some personal failing, it's a very real and very powerful psychological trap.
Just think about that one stock for a second. You remember the day you bought it, don't you? The story was so compelling. The company's future felt so bright. You were looking at your phone, just full of hope. It felt like you couldn't miss.
So let's say you hit buy at $40 a share. You're feeling good, feeling smart, you were absolutely sure this was the right call.
And then it dips a bit, down to 35. Okay, that little knot forms in your stomach, but you push it down. You tell yourself, nah, it's just some market noise, it's temporary, it'll bounce back for sure.
But it doesn't bounce back. Nope, it keeps on sinking. Now it's at 25. And that's when the story in your head starts to change, doesn't it? It's not that you made a bad call. No. It's the market that's being completely irrational.
And this, right here, is the moment the trap slams shut. You're staring at your phone, just feeling defeated. You've completely stopped asking the right question, which is, should I own this today? And you've started asking the wrong one. How do I just get my money back? That's not an investment strategy. That's a cry for help.
So what is going on here? Why does this feel so uniquely awful? And why is letting go so incredibly hard? Well, it turns out there's a pretty shocking scientific reason for all this, and once you understand it, you've taken the first step toward fixing it.
It has a name, the sunk cost fallacy. It's basically a glitch in our thinking, where the money we've already spent, money that's gone forever, by the way, starts to dictate what we do next. We make decisions based on the past, instead of looking clearly at the future.
And this isn't just pop psychology. This is the Nobel Prize-winning work of economist Richard Thaler. He discovered this thing he called mental accounting, where we basically put money we've invested into a special box in our brains, a box we feel this weird obligation to rescue, even when it's a lost cause.
You see, here's the fundamental conflict. Our brain gets totally hung up on the past cost, obsessed with the price we paid. But a truly rational decision, it can only be made by looking at the future value. What is this thing worth right now, and where is it likely to go from here?
Now, based on my research into the neuroscience here, that sinking feeling in your stomach when you look at the red numbers, it's not you being overly dramatic. Brain scans have shown that our minds process financial loss using the exact same neural pathways as physical pain. It literally, physically hurts.
And if you think that's wild, get this. The pain of a loss is felt about 2.5 times more powerfully than the pleasure from an equal gain. Let that sink in. Losing $100 feels as bad as gaining $250 feels good. Our brains are hardwired to avoid that pain at all costs.
Now, you might be thinking, okay, that's me with my small account, but this trap, it catches the biggest fish in the sea. This exact psychological flaw operates at the highest levels of the financial world, and when it does, the results can be absolutely devastating.
So let's talk about a company called Metallgesellschaft back in the early 90s. They put on this massive, complex trade hedging oil contracts. But then, oil prices took a nosedive, and suddenly they were staring down the barrel of huge paper losses. Instead of cutting bait and rethinking their strategy, they got anchored to their initial investment. They just kept doubling down, throwing good money after bad, until the board had no choice but to step in and force a sale, crystallizing a $1.3 billion loss. In my view, at that point, they weren't investing anymore. They were just negotiating with their own past. Every single new dollar they threw at the problem was just a desperate attempt to prove their original decision wasn't wrong. It was a catastrophic failure of what I call editorial oversight, the ability to step back and ask the cold, hard question, is our original story still true?
Okay, so that's the diagnosis. It sounds a little bleak, but the good news is there are ways to escape this trap. There are practical, simple ways you can upgrade your own mental software to fight back against this bias, and you can start today.
All right, here's your mental toolkit. Number 1 is the clean slate test. You just ask yourself one simple question. If this were cash in my account right now, would I buy this stock at this price today? If the answer is no, well, there's your answer. 2. Separate the past from the future. The goal isn't to get back to even. The goal is to have your money in the absolute best place it can be, right now. And 3, and this is a big one, set your selling rules before you even buy the thing.
And I love this second strategy because you can literally do it right now. Go into your portfolio and just imagine changing the column header from profit/loss to a simple question. Is my original thesis still valid? Yes or no? That tiny change forces your brain to stop looking backward at the price you paid and start looking forward at the reason you own it.
And this is so important, so listen up. Selling a losing stock is not an admission of failure. It is not proof that you were wrong. It is proof that you are now thinking clearly. It's a sign of strength and discipline, not weakness. All right, so let's boil it all down. The problem is the sunk cost fallacy, this mental glitch that makes us cling to our losers. The science tells us it's because our brains process these losses just like physical pain. And the solution is your new toolkit, the clean slate test, focusing on the thesis, and setting your exit rules before you get in. Subscribe to Money Psychology Explained if you think my video was useful and want to keep learning how to make smarter financial decisions with confidence. Don't forget to like, share with your friends, and drop a comment below.
So I'll leave you with this one last thought. The next time you look at that losing position on your phone, just remember, the loss is already real. The money is already gone, whether you sell or not. The only question that actually matters is, what are you going to do now?